Hi, welcome back to Joe Blogs. In today's episode, I want to provide you with an update as to what's happening in the Turkish economy. Now, it's been some time since I posted a video on Turkey, and a lot has happened over that period. Back in June 2023, following President Erdogan's re-election for another 5-year term as president, he appointed the first ever female head of the Bank of Turkey, and she instigated a change of policy. Prior to this period, Turkey had been operating a contrarian policy. At times of high inflation, usually you would expect interest rates to be increased, which increases the cost of borrowing and therefore discourages both companies and individuals from taking on more debt and spending. And so as spending is reduced, so is demand, and therefore prices should come back down. That's the classical theory. However, Turkey hadn't been following that theory, and as a result, inflation got out of control. However, the new head of the Bank of Turkey decided that she was going to follow a more traditional route and started increasing interest rates. And over the last 21 months, Turkey has introduced 9 consecutive interest rate rises. But unfortunately, that change in policy hasn't had the desired effect, and the latest inflation figures show that Turkey's inflation is now the 4th highest in the world, and it's the highest that it's been since November 2022. So in today's video, we'll go through the details as to exactly what's going on in Turkey. We'll have a look at what's happened to inflation, and we'll also talk about what's going on with food inflation. We'll have a look at what's gone on with regards to the changes in the interest rates. We'll also talk about the fact that the new head of the Bank of Turkey has actually resigned recently. We'll then go on to look at what's going on with regards to the currency, because the Turkish Lira has continued to devalue and is now at its lowest point that it's been in its history. We'll then talk about what's going on with the balance of trade and the current account. And finally today, I'll wrap up with my summary as to what I think is going on in Turkey right now and what's likely to happen over the course of the next 3 to 6 months. But before we get started on all of that, I'd like to say once again, thank you so much to everyone that's supporting the channel. It really does help to motivate me and keep me going. So if you've bought me a coffee or sent me a YouTube super thanks, thank you for the time and effort that you've taken to do that. I really appreciate it. And I know some of you have sent me some really big ones recently, so thank you for that. Also, if you've signed up as either a Patreon, a YouTube member, or a Buy Me a Coffee member, thank you for your long-term support. All of that really does help to keep me motivated, keeps me thinking up new titles, and I try to post videos as often as I can. So thank you for your support. As I mentioned at the start of today's video, following his re-election for a new 5-year term, President Erdogan appointed the first female head of the Bank of Turkey. Hafize Erkin was 41 years old at the time of her appointment and had previously been a managing director at Goldman Sachs in New York and was also the former co-CEO of US First Republic Bank. And the first thing that she did in her new role was to change the strategy that Turkey was following. Previously, as I mentioned at the start of today's video, Turkey had been following a contrarian policy. She decided that that wasn't working and that she was going to follow a traditional economic theory of increasing interest rates at a time of high inflation. This chart shows the movement in the official rate of interest in Turkey over the last 3 years. In April 2021, the official rate of interest in Turkey was 19%. And at that time, the official rate of inflation was 17%, which would be considered as extremely high in most economies in the world. And as we've discussed, the usual way of dealing with high levels of inflation is to increase interest rates. However, as you can see, over the following 2 years, Turkey did not increase its interest rates, and actually it decreased the rate on 8 separate occasions. And by April 2023, the official rate of interest was down to 8.5%. And at that stage, the official rate of inflation had increased from 17% to 70%. If we now look at what's happened in the period following Erkan's appointment as the head of the Bank of Turkey, you can see that there have been 9 consecutive interest rate increases, and these increases have been significant, and the official rate of interest in Turkey has moved from 8.5% in June 23 to the current level of 50%. And just to put that into context, this table shows the countries with the highest rates in the world. And this shows that Turkey now has the 3rd highest rate of interest in the world. The only 2 countries with higher rates are Argentina, where it's currently running at 80%, and the Argentinian economy is completely out of control at the moment, and Venezuela, where the official rate of interest is 59%. And Venezuela is also in a world of pain as a result of the sanctions that have been applied against the country. And the current interest rate of 50% in Turkey is almost double the next country on the list, Ghana, which is at 29%. And then we've got Egypt, Malawi, Congo, Nigeria, and Iran, all of whom are having severe economic problems right now. So let's take a look at what's happened to inflation over the last 9 months and whether or not the change of policy has had the desired effect for Turkey. This chart shows the movement in the official rate of inflation in Turkey over the last 5 years, and the period that I really want to focus in on is what's been happening since the end of 2021 as we came through the COVID pandemic and the world started to open up. And what we can see here is that in November 21, inflation was running at 21% in Turkey, which is extremely high when you compare it to the levels that we're seeing in developed economies right now. However, in the 12 months between November 21 and November 22, inflation exploded in Turkey and hit a high of 85% in October 22. Now, interestingly, as we've just discussed, during that period, the Bank of Turkey decided that it wanted to keep reducing interest rates, and that potentially kept fueling inflation. However, between October 22 and June 23, the official rate of inflation actually started to come back down. And by June 23, it hit 38%, which admittedly is still extremely high, but is a lot lower than 85%. But if we now zoom in and have a look at what's been happening with inflation over the last 12 months, and particularly what's happened since June 23, which is when the new policy was introduced and Turkey started increasing its interest rates, you can see that there's a direct correlation between the increase in interest rates and the increase in inflation. In July 23, inflation jumped from 38% to 48%. It then rose to 59% in August, hit 62% in September, October and November, rose to 65% in December and January, hit 67% in February, and in March 24, the official rate of inflation was 68.5%, which is the highest that Turkey has experienced for 16 months since November 22. So the big question here is, why hasn't this traditional policy worked? We had a very experienced financial individual who was appointed as the head of the Bank of Turkey, who decided that they needed to change the strategy to bring in more traditional methods to bring down inflation. But what we've seen is the increase in interest rates has actually driven inflation back up. And that does seem a bit puzzling. But this all has to do with what's happening with the Turkish Lira, which we'll come on to talk about in a few minutes. This chart shows the movement in food inflation in Turkey over the last 5 years. And if you follow the channel, you know that I always like to have a look at what's happening with food inflation when we've got extremely high rates of general inflation, because increases in the price of food always affect the poorest members of society the most, because they're spending a much bigger percentage of their weekly budgets on food. In some cases, it can be 90 to 100% of their free cash is going on food. And what we can see here is that food inflation has followed exactly the same pattern as general prices. However, the levels are higher. And in March 24, the increase in the price of food hit 70.4%. And one of the reasons that that is a major problem is that wages have not been increasing at anything like 70%. So that means that people have less net disposable income, they're spending a higher percentage of their free cash on food, and some people in Turkey are struggling with these price increases and are therefore able to buy less food and put less food on the family table. One of the problems with rampant inflation is that it devalues your currency, because if you're being paid in Lira every single month, but prices are rising by 70% year on year, either you need your wages to go up by 70% just to be able to buy the same amount of things, or the purchasing power of the Lira in your pocket is going down every single month. And that's exactly what's happening in Turkey right now. And what that means is that nobody really wants the Lira, and everybody in Turkey is feeling more comfortable if they're using other currencies. And that means that the demand for Lira is falling, and as a result of that, the value is also falling. This chart shows the movement in the exchange rate between the US dollar and the Turkish lira over the last 5 years. And what this shows is that 5 years ago, 1 US dollar was trading for 5.5 Turkish lira. Today, it's trading for more than 32, which means that the value of the lira has fallen by almost 6 times over the last 5 years. And if we look at what's been happening since inflation started to take off, you can see that the devaluation of the lira has accelerated. And if we zoom in and have a look at what's been happening over the last 12 months, this time last year, 1 US dollar was trading for around 19 lira, which means that over the last 12 months, the lira has devalued by more than 40%. And the knock-on implication of this rapid and continued decline in the value of the lira is that people are turning to the US dollar and the euro rather than being paid and holding their savings in Turkish lira. And what that means is that the black market use of foreign currencies has increased significantly in Turkey over the last 3 years. And this goes some way to explaining why the increase in interest rates hasn't had the desired effect in terms of bringing inflation back down, because there is only a relatively small portion of society who are still using the Turkish lira on a wholesale basis. And this is predominantly people who are being paid by the state who can't get paid in any other method. They're being paid in Turkish lira, and so they're having to use that lira to purchase things, and their savings are going into lira. And that's relatively small. So what's happening is when interest rates go up, and so the cost of borrowing lira and the cost of saving in lira goes up, it's only affecting a relatively small part of society. A lot of other people are using dollars and euros, and so they're unaffected by changes in the interest rate for the lira. And so that's why inflation has continued to go up, because the small part of society who are continuing to use lira are being affected, and their prices continue to rise as a result of the fact that the value of the lira is falling in the international markets. So when Turkey is importing goods, the cost of those goods in lira continues to rise. So what's happening with interest rates isn't really having the desired effect, because it's not reducing demand. People still need to buy food and various other things. And because the value of the lira falls, the price of all of those items goes up, and that's driving up inflation. So the traditional method of dealing with high rates of inflation isn't working, because we've got a high rate of dollarization in the Turkish economy. People are not using the Turkish lira if they can avoid it. Everybody would prefer to use other currencies because they're not devaluing by 40% year on year. They're remaining relatively stable. And this becomes a really big problem for countries like Turkey, because how do you actually solve rampant inflation? This chart shows Turkey's balance of trade over the last 5 years, and the balance of trade is basically the difference between the value of all of your exports and the cost of all of your imports. So basically it tells us whether a country is earning money on a net basis from what it's selling compared to what it's buying, or whether it's actually spending money. So if you have a negative balance of trade, you're a net importer, you're buying more things than you're selling. If you have a positive balance of trade, then you're selling more than you're buying. And the scale on the right hand side of this chart is shown in billions of US dollars, and starts at the top at 0 and goes down to minus 15 billion. And what we can see here is that over the last 5 years, Turkey has run a negative balance of trade in every single month. So basically it's telling us that Turkey is a net importer, it's buying more than it's earning from its sales, and therefore that puts pressure in terms of how do you actually fund that? How do you keep funding an economy which is constantly spending more than it's earning? And once again, if we zoom in and have a look at what's been happening over the last 2.5 years since inflation got out of control in Turkey, you can see that the balance of trade actually got worse during that period. In October 21, Turkey had a negative balance of trade of $1.5 billion. However, by January 2022, that figure had increased to negative $10 billion. And by January 2023, it had increased to more than $14 billion. And if we zoom in and have a look at what's been happening over the last 12 months, the first thing to take away from this chart is that every single month is in negative territory. Turkey is continuing to spend more than it earns, And as the value of the lira continues to fall in the international markets, partly as a result of the high levels of inflation, it's likely that this situation is going to persist for the foreseeable future. And that represents a major problem from Turkey's point of view because they need to keep funding this spending. And this chart shows the movement in Turkey's current account over the last 12 months. And the current account is similar to your checking account. It tells us how much cash Turkey has. And what this shows is that Turkey has run a deficit on its current account in 9 out of the last 12 months. Now, I think it's interesting that Turkey has actually achieved positive territory on its current account in June, September and October. And the reason for this is that Turkey is a very attractive tourist destination. In Europe, a lot of tourists go to Turkey. It has really nice beaches and great weather. And as a result of that, it does have a large influx of foreign currency at times when there are a lot of tourists coming. And if you take a step back and have a look at this chart, you can actually see that there's a positive trend from left to right. We've got a reduction in the amount of deficit that Turkey is running on its current account. And one of the reasons for this is that Turkey has been borrowing money. So what's the summary and conclusion today? Well, I wanted to post this video because I haven't posted a video on Turkey for a long time, and I've got a lot of comments recently from people saying, I'd really like to know what's going on, can you give us an update? So I wanted to make this video. And I think it's interesting that inflation is now at its highest level that it's been for the last 16 months. It's now starting to rise rapidly again. And as we saw from the data, it's the 4th highest in the world at the moment. And that really isn't an accolade that Turkey was looking to get. It did have problems with inflation around 18 months to 2 years ago, and it looked like those problems had been sorted out on a relative basis. It had come down from around 85% to less than 40%, which from Turkey's point of view was obviously positive progress. However, the appointment of the new head of the Bank of Turkey and the change of strategy hasn't really worked from Turkey's point of view. It looked like it should. It looked like if you start increasing interest rates, the traditional theory tells you that that should reduce spending, therefore reduce demand, and therefore result in a fall in prices. And the aim of the game was to bring inflation down to the target rate, which in Turkey is 5%. And obviously, it's a million miles away from 5% at the moment. However, as we've seen over the last 9 months, that new strategy was completely ineffective. In fact, it was worse than ineffective. It actually drove inflation back up. And we've got a current rate which is close to 70%. So over the last 9 months, inflation has almost doubled in Turkey, despite the fact that it's now following the traditional methodology of how to deal with high rates of inflation. And the reason why this hasn't worked, as we discussed in today's video, is because there's now a disconnect between what's happening in the economy and what's going on with interest rates. Because of the fact that the lira is devaluing almost on a daily basis, you can buy less and less every time you go to the shops. And the reason for that is because Turkey is a net importer. It's importing lots of things, predominantly fuel, so it's importing large amounts of oil and gas, and also food. And they're basic items that most people in society have to buy. And because they're buying them in the international markets, they're priced either in dollars or euros, or potentially some other currency when Turkey is dealing with Russia. And that then has to be converted into lira when it's priced in the Turkish markets. And as a result of the continued fall in the value of the lira, those prices continue to go up, and that's driving up inflation. And because of this, most people in Turkey don't want to be paid in lira, they don't want to hold their savings in lira, and they don't want to use lira in the shops. They would much rather be using US dollars or euros. And as a result of that, when you're increasing interest rates on an official basis, it's not having an impact on all of those people who are not using lira because they're totally unaffected. When they take their US dollars or euros to the store, they get given a price in dollars or euros. So movements in the value of the lira don't have any impact on those people. And that's why we've got a disconnect between what's happening at the central bank level and what's happening with inflation. And this is now a major problem from Turkey's point of view, because how do you solve rampant inflation if you can't fix it with interest rates? Well, obviously the other thing to do is try to get everybody back to using the Lira. And that's what President Erdogan has been trying to do over the last couple of years. He's introduced a variety of different methods whereby companies and individuals were encouraged to hold their savings in Lira, to convert all of their foreign currency into Lira, and even to sell gold in exchange for Lira. However, the problem with these schemes is that if the Lira continues to go down in value, it's eroding the value of people's savings. And that's exactly what's happening right now. And the people in Turkey are now very nervous about holding all of their money in Lira because it is devaluing on a daily basis. And as a result of that, there is now this black economy which has grown up, and it's going to be extremely difficult from Turkey's point of view to fix that. The central bank doesn't have control of a lot of the economy because it's happening in dollars and euros. And in terms of what's likely to happen over the course of the next 3 to 6 months, obviously Turkey isn't going to be able to solve this problem, so we're going to see a continuation of this trend. It's likely that we will see inflation continuing to rise, and therefore we will see the Lira continuing to devalue, and that is going to become a vicious circle because Turkey is importing all of these vital products. So the overall summary of today's video is that the change of strategy that's been implemented by the Bank of Turkey over the last 9 months hasn't proved to be successful as a result of fundamental problems going on in Turkey right now. It's going to be very difficult to turn this situation around, and over the next 3 to 6 months, it's likely that we will see the situation getting worse. So I'll keep you posted on any major developments that happen in the Turkish economy. Hopefully you found today's video useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.